So let's have a sesh on venture capital. So the definition of venture capital, it's a type of finance offered by a venture capitalist fund to, and this is the key thing, to high risk, high reward firms. High risk, high reward firms in exchange for a share of the business. And it's very likely these high risk, high reward firms are in, if you want to link it to the product life cycle, they're in either or the research and development phase or the introduction phase of the product life cycle. In terms of venture capital, when it's a long-term source of finance, it's external, it's coming from outside the business, so it's external finance, and it's for startup or new businesses, very commonly tech firms. The pros and the cons of venture capital. Well, number one, because they're high-risk firms, no one, for example, a bank, probably was willing to lend to them because it was an enormous amount of money that needs to be invested at a high risk, and the bank wasn't interested. So really, it just makes expansion possible by using venture capital firms. Makes expansion possible because otherwise no one else might have been interested. Number two is that it's a type of equity finance, and therefore this finance that the venture capitalist fund give to you, well, you don't need to repay it. It works exactly the same as shares or share issues. Number three is it reduces the personal risk to the founder, to the owner of the business, the original founder of the business. And therefore, they've reduced the amount of risk that they're taking on now because they've given a lot of the risk to the venture capital fund. And the final thing is that these venture capitalist funds, well, often they have lots of expertise because they may have done this for similar firms in other industries or the same industry as you. So they've got expertise, and this could be absolutely crucial to making your business a success. The cons of venture capital. Well, number one is that you've given up a share of the business. And if you've given up a share of the business and this high risk actually does turn out to give high reward, this firm now is giving high reward, high profits, well, you need to split those profits up and give them to, or a part of them to, the venture capitalist fund. Number two is that this is a form of equity finance, so you may lose control of your business. And if you give up 50% of the share of the business, then you're actually going to lose possibly your decision-making power, and that could be critical to you as the founder of the business. And number three, the final con, is that venture capitalist funds, ultimately, they want to get out of the deal. And what I mean by that is that ultimately, they want to sell up your business when it becomes a success, often through an initial public offering when it moves into a public limited company onto the stock exchange. So you've got to be aware as a founder that ultimately they want to exit your company because they are looking to make a profit. I hope that helps with venture capital, and I'll see you at the next sesh.